Conversations about women and money often jump straight to the gender pay gap, but I actually think there is a deeper challenge here that doesn't get nearly enough attention. And that is, as women, we often face a very different financial reality over the course of our lives. Not only are we more likely to live longer, but we're also more likely to develop chronic health conditions. What this means for retirement is that it's often longer and more expensive. So the real issue here isn't just retiring with lower balances, it's that women need more to achieve the same level of financial security.
Today I would like to talk about asset allocation and why it matters for long-term investments like superannuation. When I say long-term, I mean at least 10 years. It's important for investors, especially women, to check whether their current investment mix is appropriately positioned to meet their future goals. Women often contribute less to investments over their lifetime due to lower average earnings and more time out of the workforce. At the same time, women tend to live longer. This means higher long-term returns are required to bridge the gap between lower contributions and higher savings goals. Women are often thoughtful and cautious investors, which is a strength, but sometimes that caution leads to being too conservative. I'm definitely guilty of this myself. One helpful tip is to reframe how women think about risk. Instead of focusing only on the market's short-term ups and downs, ask yourself a couple of questions. Number one, what's the risk I won't meet my long-term investment goal? And number two, what's the risk inflation erodes my purchasing power over time?
One of the most important principles in investing is that time in the market is far more powerful than timing the market. This is because consistently and accurately predicting short-term market movements is nearly impossible, even for professionals. Attempting to do so most of the time results in missing out on significant gains. And to put this into perspective, over the past 30 years, if you missed out the best 30 days in S&P 500, your returns will be cut in half. Missing out the best 30 days in the market, your returns will be lower by 80%. We believe a long-term disciplined investment approach is one of the most effective ways to build wealth and help narrow the financial gaps that many women face due to career breaks and lower lifetime earnings.
There's a misconception that to be a good investor, you have to be really into it. You need to be watching financial media like a hawk, tracking company announcements, and analysing charts. Some investors enjoy this, and there's nothing wrong with being interested in markets, but it's not a requirement for success. For most people, the goal isn't to make investing their full-time hobby. The goal is to build wealth so you can live the life that you want to, and you can absolutely do that without making it your passion project. The beauty of investing today is that you can automate so much of it. You can set up regular contributions into a diversified ETF or fund, and just let time and compounding do the heavy lifting. We know from behavioural research that women often set a higher bar for themselves before investing. They want to understand everything first. The irony is that many of the traits that are holding women back from investing, caution, discipline, and realism, are the same behaviours that make us such great investors. They underpin strong, long-term investment outcomes. We just need to get over the hurdle of getting started.
Amidst all this, financial literacy in Australia is on the decline and women are being disproportionately affected. This metric is essential to improve. Luckily, there are things we can do. At Morningstar, championing and empowering the investor is at the absolute heart of everything we do. I'm incredibly proud that we provide free and accessible content, particularly through my Young and Invested column on a weekly basis. Whether it's optimizing asset allocation, trying to reduce costs, or simply making those behavioral changes, the right information can drastically shift your financial future.
So across my career assessing funds manager, one thing has remarkably stayed consistent, and it's the underrepresentation of women in the industry. So today we know that 13 to 15% of all investment professionals are women. Yet we know that diversity, including diversity like gender diversity, is very essential to decision making. When you bring diversity to the table, you have more debate, more challenge, less groupthink, and better decision making at the end. So for us, part of assessing a fund's management ability to make good decisions, we are assessing the team. And diversity of thought is very central to what we are doing. We are looking at the quality of the team, the quality of the investment decision. And if this diversity of thought is missing, it might be a sign of cultural weaknesses, which ultimately can lead to less innovation, less competitiveness, and less good return for our clients.
I hope that hearing these stories from my colleagues has shown you the importance and you move forward with confidence to take control of your outcomes.